Hey, how's it going, everyone? My name is Derek Afasi. I'm the owner of Afasi Financial Group. Today's topic, I want to discuss with you what is pension income and go over the differences of single life pension income, joint life pension income, what are some of the problems with that, and then how you could maximize your pension income with the proper strategies by leveraging different types of product lines or different types of strategies to make sure that you're always getting that optimal result. So what is pension income? Pension income, this is also known as, or what is a pension plan, is also known as something known as a defined benefit plan. So what typically happens, I'll use the example of my grandfather. I use it in a lot of my different videos. But what happened was my grandfather was an elevator mechanic for the city of New York. And what would occur was he would go to work each and every day, and that the entity, the city of New York, would essentially take a portion of his salary and place it aside to then accumulate with thousands and millions of other individual salaries that work for the city. For after he hit X amount of years of service, he would be able to receive a defined benefit, an actual defined amount of money known as a pension income for the rest of his life or his and my grandmother's life. So unlike a defined contribution plan, which has now gravitated towards, how majority of retirement plans are set up right now, like the 401k, 403b, 457 plans, etc., defined benefit plan, they define exactly what your benefit's going to be. So what would happen was these individuals would go to work for a company, work for an entity. They would be able to focus on their work, enjoy their work, and understand that after they hit X amount of years of service or they hit a certain age requirement, then they were able to trigger lifetime income. So it's as if they're still receiving a salary, but they don't have to work for it. It was all money that was placed aside for them that the entity invested on the back end to make sure that they could suffice paying out income for the rest of that individual's life. So I hope that all of that makes sense. So one of the stories that I always talk about is I said my grandfather, when it came time for him to retire, he was walking out the door and he actually chose the single life only income as his pension income. And my grandmother just so happened to be standing by the door at the time, and she stopped him and she said, "What are you doing?" And they get into a huge argument. He was, letting her know, well, if I take the single life only option, I'm going to have X amount more thousands of dollars than if I take the joint life income option. So, after their little fight, their little tidbit, she ended up winning the fight and understanding that they took the joint life income option to cover both him and her for lifetime income, which was very, very beneficial. Let's just say in a given example, with a person that has that option to either choose single life only income or joint life income, let's say single life income would provide him $60,000 per year for the rest of his life, or joint life would provide $40,000 per year for the rest of both of their lives. Well, this would say after he passed away, well, then all that income would stop. With joint life income, after one spouse passes away, the $40,000 would still continue. So understand that they're getting, because there's a larger risk on the employer to provide that much more income, because now you have two different lives that you have to insure. They will try to incentivize you and make you choose that single life only option because the mortality tables are in their favor to say, okay, yes, we'll make this seem really appealing, that $60,000 number. So therefore, individuals gravitate towards that, so that when that person passes away, we don't owe another dollar. There's no death benefit. There's no nothing left to that beneficiary, as opposed to the joint life. Maybe the joint life is going to get paid out for 30 years, but the single life income, unfortunately, that person passes away after 15 years. So therefore, even though it looks more appealing in the beginning, the joint life income to protect both you and your spouse might be a better option altogether. So let me clear off the screen and go to section number 2. So what are the problems with a single life or joint life income? Well, you understand with the single life income, if that person passes away too soon, well, they would have worked all those years, would have accumulated that type of income benefit, but that income benefit could have gone by the wayside if they would have passed away really soon. The example of my grandfather, he ended up retiring in his late 50s and he ended up passing away at age 69. So my grandmother ended up living into her late 80s before passing away, and therefore, it was a really good thing that she won that battle, that she won that fight, because that pension income, she didn't have to worry after he passed away, because that pension income did not stop. The pension income remained exactly level, exactly the same, each and every year for that peace of mind. Now, understand that so that's kind of the problem with the single life income option is if you're married and you want to make sure that your spouse is covered properly, well, then you might want to go more gravitate towards that joint life income option. The downside to the joint life income option is you're taking a reduced benefit than the single life income option. Maybe in that example I said, single life income option might have paid him $60,000, but both of them, they could have been paid $40,000. So that's a $20,000 difference. That's a major problem because you're giving up $20,000 per year. If you're trying to equate that every 10 years, that's $200,000, or every 20 years, that's $400,000 worth of pure benefit that you're giving up. So what exactly are some solutions to these problems? And that's why I have bullet point number 3. This is how to maximize pension income with proper strategy. Now, the very first strategy I want to talk about is known as arbitrage, where if the individual is healthy, the individual that has that pension income that could either choose that single or joint life option, in my case, in my example, my grandfather's case, if he was insurable, they could essentially take out a life insurance policy, not a cash value life insurance policy. It's something known as a GUL to reduce your insurance costs significantly. It kind of works like a permanent term life insurance policy, so it's like a term to age 121. That's the way that you have to think of it, like an umbrella over his head, a coverage over his head for until age 121 or 120, depending upon which carrier that you go with. There's different ways on how you could set that up. So what you could do is he could have taken out the single life income option, say $60,000, and then utilize $10,000 to then purchase we could just use a hypothetical example, a $500,000 death benefit, tax-free death benefit to his loved ones, so that she could be so now my grandmother could have been the primary beneficiary. So in this sort of example, he would have $500,000 of tax-free death benefit that would get paid out to his beneficiary, God forbid if he was to pass away, and they would still be netting an extra $10,000 than what the joint life income option is. So each and every year, let's say if he was living, he passed away after the 15th year, well then she would have still been able to reap those benefits of that extra $50,000, or the $10,000 more dollars than the joint life income option. But she would also receive a tax-free death benefit of $500,000 at that time of his death. Now, let's say if she passed away before he did, well, then he could cancel his life insurance policy, and he would have stepped up income of $50,000 net to a $60,000 net, and therefore would still be living for the rest of his life. So that's just a really simple strategy. It's known as arbitrage, where you could leverage life insurance, but it only works when that person is insurable, and you could get a good enough death benefit, with that specific situation. With his situation, it might not have worked as well because he was also a smoker. So, if him being a smoker, it could have also increased his cost of insurance, and maybe not a $500,000 death benefit, but maybe a $250,000 death benefit. So there's kind of a perfect, precise pinpoint to see whether or not that makes sense. Another example, let me clear off the screen, and this is something that if you're offered a lump sum option, basically like a get out option, where the company says we could either provide you X amount of thousands of dollars per month, or we could provide you a nice lump sum amount. So it's all about kind of configuring those numbers and seeing whether or not it makes sense, where sometimes individuals could actually take the lump sum option rather than the pension income option, and they roll that over into a specifically designed annuity contract that will provide them max joint lifetime income. So rather than, let's say, the pension option, you could go with option A that says, okay, single life income option for $60,000, and you could use the arbitrage technique through life insurance. You could do option B, which would say joint life income option of $40,000, and just understand that'll be $40,000 for the rest of your life. Or let's say you have a lump sum pension option that they'll give you a get out option of, let's say, $600,000 that might be able to provide a single life income of $65,000, which you could still utilize that arbitrage technique, or whatever you do not use up would go to your beneficiary. So now you have more control over that full lump sum amount of money. Or you could even use the $600,000 to then maybe provide $50,000 of joint lifetime income, and also whatever you guys do not use up would then go to your beneficiary. So what you're doing is now you're having more control of your money, you're having more control of your chips. Understand that lump sum option works in some cases, and other cases it doesn't. So it's going to be a case-by-case basis, depending upon how old you are, depending upon what the amount of money is that they're going to provide you for a lump sum option, depending upon your state, depending upon how long you want to trigger income. If you want to trigger income in the next 30 days, if you want to wait a couple of years, maybe correlate that to Social Security income, whatever that case may be, it has to be precise, and it has to make sure that you're setting it up for the best possible leverage so that you could maximize your pension pension income or your different income options at the end of the day. And that's just some of the things that we do here at Afasi Financial Group. We're an independent agency. We offer 24/7 customer service. So you give us a call mornings, nights, weekends, holidays, whatever the case may be. And you can say, hey, listen, I have a pension income coming to me, or I'm trying to figure out my pension options, which would be the best plan of attack. And you would deal with the specialist, and the specialist will help educate you and go through and call over the company with you and really figure out what you have. Kind of, is there something that could be better out there, or should you just stay the course? Should you take single life income option through an arbitrage strategy? Should you do joint life income option without the arbitrage strategy? What are some of those different criteria to make sure that you're maximizing your chips to the best benefit possible? We utilize a certain process known as a Retire Sharp planning system that allows us to go through over 1,200 different product strategies, concepts before we give our top 3 recommendations on what might be the best route for you. There are times that we are able to help out individuals tremendously, save them thousands upon thousands of dollars, make sure that they're receiving thousands of more dollars of lifetime income each and every year, as opposed to just going into the one option that they thought they had. So we like to uncover some of the best options and really leverage some of the best product lines out there and the best companies out there to make sure that you could utilize them like a perfect puzzle piece. Because we're an independent agency, we're not going to be biased towards one company over the next. We care about the client. We don't care about the company. And that's, very apparent with all my videos that I try to stress to you guys. It's all about you. It's not about the company. So even if you're sitting down at a seminar, you heard an advertisement, do not just go blindly into that type of product, because majority of these types of contracts, I'd say about 90% of them are not good types of contracts. So you have to make sure that you pinpoint the specific contract. And that's what we try to help you out with. We educate you, and then we show you the best solutions for your particular situation. We are A+ rated on the Better Business Bureau. We've always had very good reviews. We've never had any complaints, and it's because of this methodical process. I want to thank you very much for watching this video. Please feel free to subscribe to our YouTube channel, Retire Sharp, so you can have access to the most updated videos. Thanks so much, guys.